Hello everyone, this is chapter 12, Cost of Capital. This chapter we will see how to find firm's overall cost of capital. We will use valuation model of each security. So it will be a kinds of review for some of previous chapters, especially chapter 6, 7, and 11. First part, we will see how to calculate cost of each type of financing, equity, debt, and preferred stock. Let's start with cost of equity. First of all, cost of financing is in fact same as the required return for investor. Because an investor provides a fund to the firm. For a firm, it is cost, and for investor, it is return. So the cost of equity is same as the return required by equity investors. It means that we can use equity valuation models to get the cost of equity. There are two equity pricing models we learned so far. First one is the dividend growth model. Dividend growth model says that the price of stock equals to next period dividend divided by the required rate of returns minus growth rate. As we saw in chapter 7, we can rearrange this formula for required rate of returns, which is in fact the cost of equity. So from dividend growth model, the cost of equity equals to next period dividend divided by current price plus growth rate. Second model we learned is capital asset pricing model. As we saw in chapter 11, there is a model to get a required rate of return on equity, which is equals to risk-free rate plus beta of a stock times market risk premium. As required return is the cost of capital, the cost of equity may be computed using CAPM2. Let's find the cost of equity in this example. The stock is beta 1.2. Estimated growth rate of 8% per year. The firm recently paid $2 dividend and current stock price is $30. Risk-free rate is 6% and the market risk premium is 8%. Using CAPM, the cost of equity equals to risk-free rate plus beta times market risk premium. So 6% plus 1.2 times 8% equals to 15.6%. Using dividend growth models, the cost of capital equals to next period dividend divided by the current price plus growth rate. Since we have current dividends, not next dividend, we should get next dividend by 2 times current dividend times 1 plus growth rate, 8%. So the cost of equity equals to 2 times 1 plus 0.08 divided by $30 plus 8% equals to 15.2%. Which one is better? It is hard to answer. There are pros and cons for each model. We will see them in the next slide. The advantage of dividend growth model is it is very easy to understand and use. We can simply use market information, stock price, and dividends, estimate growth rate, usually using historical average, and find the cost of equity. And yet, there are several disadvantages. It is only applicable to companies that pay dividends. If a firm does not pay dividends, then we don't have enough data to use dividend growth model. In addition, it is not applicable if dividends are not growing at a constant rate. The model is very sensitive to growth rate, which should be estimated, so there's huge forecasting risk for the growth rate. Finally, maybe this is the most serious problems of using dividend growth model. It does not explicitly consider risk. The model assumes that the current stock price implicitly considers the risk. So if the current price is not fairly priced, we cannot trust the cost of equity from dividend growth model. To resolve this issue, we can use CAPM. CAPM is also easy to use and applicable to all companies if beta is available. Since we directly use beta, it explicitly adjusts for systematic risk. However, we must estimate the expected market risk premium, which varies over time. We must estimate beta, which also varies over time. CAPM relies on the past information to predict the future, which carries forecasting error. First part quiz, there are 2 questions. Find the cost of equity of each question. The first question, we have beta, risk-free rate, market risk premium. So we should use CAPM. The cost of equity equals to risk-free rate 7% plus beta 1.15 times 6% market risk premium, which is 13.9%. Second question, we have dividend growth rate and current stock price. Use dividend growth model. The cost of equity equals to next dividend $4.24 divided by current price $60 plus 6% growth rate, which is 13.07%. Let's find cost of debt. You should note that the cost of debt is not a coupon rate. It is the required return on a company's debt. So it is same as yield to maturity of existing debt. We already learned how to get YTM of a bond in chapter 6. Look at the example. Current bond has 22 years to maturity with 7% coupon paid semi-annually, sold at $960. The cost of debt is YTM of the bond. Using TVM function of the calculator, and it's 22 times 2. PV is negative 960, since it is the price to pay. Future value is 1,000 par value. PMT is the amount of coupon, which is the coupon rate 7% divided by 2 semi-annual rate times par value $1,000, $35. Compute I over Y, then you get 3.685. And because this is a semi-annual rate, we should make it annual by multiplying by 2, 7.37%. Another way to find the cost of debt is to use estimate of current rate based on the bond rating on new debt. Finding all items are not easy, so this method is simpler to find the cost of debt. Unlike equity financing, debt financing changes the amount of taxes because interest paid is tax deductible. It means that we need to get after-tax cost of debt. To compute it, we should use the formula after-tax cost of debt equals to before-tax cost of debt times 1 minus corporate tax rate. If tax rate is 21%, after-tax cost of debt from our example is 7.37%. Before-tax cost of debt, we compute it times 1 minus 21%, 5.82%. Second pop quiz. If the current bond has 30 years to maturity with 5% coupon rate paid semi-annually, sold at $974.45, and tax rate is 21%, find the after-tax cost of debt. First, we need to compute before-tax cost of debt using calculator, and it's 60, 30 times 2. PV is negative 974.45. PMT is coupon 5% divided by 2 times 1,025. Future value is 1,000. And compute I over Y. I over Y is 2.5843. Annualize it times 2, 5.17%. Final one is the cost of preferred stock. As we learned, preferred stock pays constant dividend forever, so its cash flow is a perpetuity. We can rearrange the formula to find the price of the preferred stock. Price equals to dividend divided by required returns. So the cost of preferred stock, which is same as required return, equals to dividend divided by price. As shown in the example, if a preferred stock pays $1.25 dividends annually and current stock price is $25.85, the cost of preferred stock is $125 divided by $25.85, 4.84%. Pop quiz 3. Find the cost of preferred stock with following dividend and price. Using a formula, the cost of preferred stock is dividend $3 divided by current price 54.12, 5.54%. This is the end of the first part. Thank you.